It's not every day you see a stock grab headlines quite like this, but today, September 9th, 2025, Riot Platforms, that's RAOT, is just, well, it's surging. Really got people talking. So the big question for our deep dive today seems pretty clear. What exactly is driving this impressive run, especially with Riot's really strong August Bitcoin production numbers? And how is all this maybe reshaping their whole business model?
Yeah, it's a great moment to really dig in, and we've got some good sources lined up to, give you the full picture. We're looking at BDO's 2025 fintech predictions, some sharp analysis from Market Minute on crypto, plus detailed reports specifically on Riot from Simply Walsey and A-Invest. So our goal here is to kind of cut through the noise, pull out the key insights, and help you understand not just what Riot's up to, but why it matters right now, and for their future path.
Okay, let's do it. Let's unpack this with some numbers, because these August figures from Riot themselves are pretty fascinating. This seems to be the immediate spark. They put out 477 Bitcoin last month. That's an all-time high for them for August. A huge jump, 48% year over year compared to August 2024. And they didn't just sit on it. They sold 450 Bitcoin, netting $51.8 million, the average price, around $115,000 per Bitcoin. Pretty good. Riot's CEO, Jason Lay, he highlighted this himself, said it was an all-time high for Riot in the month of August, pointed out that 48% increase. But then he dropped this crucial detail, their power cost. Just 2.6 cents per kilowatt hour, all in.
That 2.6 cents number, it's absolutely critical. It's really what lets these strong production numbers feed into their wider strategy. It's a huge advantage. And it's not just about saving money on power. They've actually figured out how to turn energy management into, well, another income source. Get this. In August alone, Riot reported an extra $16.1 million in power credits. That's up 148% compared to last year, just from managing their power.
Okay, wait, power credits. Maybe let's pause there for a second. For listeners who aren't deep in Texas energy markets, what exactly does that mean? How are they making money by managing power?
Right, good question. So think of it like this. Riot participates in these grid programs like Aerocoret's 4CP in Texas and also MISO demand response. Basically, when the grid is under stress, like, say, a really hot afternoon when everyone's blasting their air conditioning demand for electricity spikes, Riot can then choose to scale back their mining operations, sometimes significantly. This frees up a ton of electricity that can go back to homes and businesses. And the grid operator, Aerocoret in this case, pays them really well for providing that flexibility, for reducing their load when it's needed most. So they're effectively acting like a sort of virtual power plant. They get paid not to use power during these peak times. It's pretty ingenious, turning a major cost center into a revenue stream.
That is fascinating. A real differentiator, turning that potential liability, the huge power draw, into an actual asset. Okay. But like you said, Riot isn't doing this in a bubble. We need to zoom out. Bitcoin itself is, well, on a tear. Around at $112,000 now, hit over $124,000 back in mid-August. What's going on in the broader crypto world that's creating such a positive environment for Riot and, the whole ecosystem?
Yeah, connecting it to the bigger picture is key. The crypto market isn't just growing. It feels like it's in this way you could call it a perfect storm scenario. You've got tightening supply meeting this unprecedented surge in demand, and it's all being supercharged by a surprisingly helpful policy backdrop. This mix of forces is really what's behind Bitcoin's current strength.
Okay, a perfect storm. Break that down for us. What are the main ingredients here?
All right, first up, post-halving scarcity. Remember Bitcoin's fourth halving back in April 2024. It cut the reward for mining a block in half, from 6.25 Bitcoin down to 3.125. And historically, these halvings tend to kick off longer bull runs because, simply put, less new Bitcoin is being created every day. Supply is tighter. Second, and this is huge, institutional demand. The approval of those U.S. spot Bitcoin ETFs early in 2024, the ones from BlackRock, Fidelity, the big names that opened the floodgates, billions have flowed into these ETFs. And often, the amount of Bitcoin these ETFs are buying actually outstrips the new supply miners are generating post-halving. That creates a really powerful demand-supply imbalance. It pushes prices up.
Wow. So shrinking supply from the halving plus this massive new wave of institutional buyers through the ETFs, I think that alone sounds like it could drive a rally. But you mentioned the policy environment, macro conditions adding fuel to the fire. What else is contributing?
Exactly. Beyond just supply and demand, the wider economic picture, as highlighted in BDO's 2025 fintech predictions, is definitely playing a role. We're seeing declining interest rates. The Fed's expected to keep cutting rates through 2025. There's basically a 100% expectation of another quarter-point cut this month, September, especially after some weaker job numbers in August. And lower borrowing costs generally make riskier assets like Bitcoin look more appealing compared to safer things like bonds. Then there's the pro-crypto administration here in the U.S. President Trump has been very explicit, saying he wants to make the U.S. the Bitcoin superpower of the world. That's not just rhetoric either. There was that executive order back in January 2025 that prohibited a U.S. CBDC and actually mandated a strategic Bitcoin reserve for the country. That kind of political backing. It's a big deal for industry confidence.
The strategic Bitcoin reserve.
Yeah.
Mandated. That sounds like the government itself treating Bitcoin as a serious strategic asset. That's quite something.
It really is. And alongside that, we're also seeing increasing regulatory clarity. Things are moving forward. We've got the Genius Act for stablecoins, ongoing talks about the Clarity Act to sort out if crypto is a commodity or security. Plus, the EU's big MiCA regulation is now fully in effect. All this provides clearer rules of the road, which reduces risk and encourages more players to get involved. And finally, just broader mainstream adoption keeps accelerating. You've got legacy companies using blockchain, putting Bitcoin on their balance sheets. Even local governments are getting in on it, like Detroit planning to accept crypto for taxes next year. Several states are talking about their own Bitcoin reserves. Add to that an expected pickup in fintech M&A, mergers and acquisitions, especially around digital assets and AI as the economy improves. It all creates a really fertile ground for crypto right now.
That is an incredibly powerful mix of factors. Scarcity, institutional money, falling rates, government support, clearer rules, more adoption. It really is a confluence, like you said.
Right.
So given this backdrop, it makes total sense that Riot wouldn't just, sit back and enjoy the ride. How are they actively adapting their own business to capitalize on this and maybe build something more sustainable than just pure mining?
Right, that's the crucial next piece of the puzzle. Riot isn't just mining more, they're making these really interesting strategic shifts, evolving beyond being just a Bitcoin miner. A big one is their move into data centers and high-performance computing, or HPC. They're actively working on building out a scalable data center platform. The idea is to support these really intensive HPC workloads, think AI applications, things like that. They're looking at their big Corsicana facility, specifically the remaining 600 megawatts of power capacity there for exactly this purpose.
Okay, so HPC, AI. They're not just waiting for Bitcoin's price to dictate their fate. They're building new potential revenue streams, possibly more stable ones. Is this already happening, or is it more of a future plan?
Well, it's definitely happening in terms of planning and development. They're leveraging the infrastructure they already have, especially their know-how with large-scale power management. The goal is twofold. Create new income, yes, but also monetize capacity that might otherwise sit idle if, say, Bitcoin mining isn't super profitable at certain times due to lower hash prices. And this fits with a broader trend we're expected to see more of in 2025, co-locating AI data centers and Bitcoin mining, using the same optimized power infrastructure for both to drive efficiency. And second, that unique energy strategy is really becoming a powerful competitive moat. We talked about the low power costs, sub 3 cents, and those big power credits, $16.1 million just in August. That gives them a cushion against market swings and rising energy costs that a lot of their competitors just don't have. It's hard for others to replicate that kind of strategic grid interaction. It's a durable edge. And third, financially, they look pretty solid. They've got a strong financial position. They're holding a lot of Bitcoin on their balance sheet, over 19,000 BTC. As of late August, that was worth more than $2.1 billion. And they even used some of that Bitcoin, about 3,300 BTC, as collateral to secure a $200 million credit line. That shows real financial flexibility.
Holding over $2 billion in Bitcoin. That's significant. But doesn't holding that much Bitcoin also expose them hugely to the price swings we talked about? How do they manage that risk?
That's a really sharp question. Yes, absolutely. Holding that much Bitcoin means they're directly exposed to its price volatility. There's no escaping that. But the way they seem to view it, and how analysts often frame it, is that the Bitcoin holding itself is a strategic asset, almost like part of their treasury. It gives them options. They can sell it strategically, use it for collateral like they just did, or hold it for potential long-term gains. It kind of positions them as this Bitcoin plus cash flow company. They have the mining revenue plus this significant liquid asset base. It adds a layer of resilience. And Wall Street seems to agree, mostly. Analysts are generally bullish. The consensus is a buy with, 44% rating at a strong buy?
Okay, it paints a very positive picture, and you can see why the stock is surging today. But, for a balanced deep dive, we have to look at the other side too. What are the main challenges or risks still facing Riot's and the mining industry generally? And maybe tackle that question I know a lot of people ask, why don't mining stocks like RIT just perfectly track the price of Bitcoin, especially when Bitcoin's doing so well?
Absolutely essential points for a full understanding. First, despite the bullish long-term view, Bitcoin price volatility is still the elephant in the room for Riot's earnings. Short-term dips, maybe 15–25%, are always possible. And historically, September hasn't always been Bitcoin's strongest month, so that's something to watch. Volatility is inherent. Second, the mining competition is fierce. That halving event didn't just cut rewards, it really cranked up the pressure. The network hash rate, the total computing power competing, hit a record high in August, 129 trillion EHs. That pushes up the mining difficulty, which squeezes margins for everyone. If you're not super efficient, you're going to struggle. We could see more consolidation. And there are operational headwinds too. Riot themselves actually revised their 2025 hash rate target downwards a bit, from nearly 47 EHs to around 38 EHs. That suggests they're being maybe a bit more cautious, possibly due to supply chain issues for hardware, or maybe just adjusting as they pivot towards HPC. It shows they're realistic.
Right. Realism is important in such a competitive space. Okay, but that other question, why doesn't RIOT stock just follow Bitcoin perfectly? What causes that gap sometimes?
Yeah, it's a common point of confusion. Mining stocks like Riot are definitely correlated with Bitcoin, but they're a different beast altogether than just holding Bitcoin directly. Think about it. A mining company has all these other factors influencing its stock price. Its own operational cost power is huge, but also hardware, staff, its debt levels matter. How much are they spending on expansion, on new machines? Are they issuing new stock, which dilutes existing shareholders? And then there's just general stock market sentiment. Is the tech sector up or down? Are people shorting the stock? So their profitability, and thus their stock price, depends not just on Bitcoin's price, but on how well they manage all those business variables, how efficiently they can mine relative to the growing difficulty. It's a complex operating business, not just a proxy for the asset. And one last point. Even with Riot's smart energy plays, the overall energy consumption of Bitcoin mining is still under scrutiny from the public and regulators. That's an ongoing narrative the whole industry has to navigate carefully.
Okay, so wrapping this up, we've taken a pretty deep dive into why Riot Platforms is having such a strong day today, September 9th. It really seems to be this powerful blend, fantastic August production numbers, that super smart strategic energy management, which is actually generating cash, all happening within this incredibly positive macro and regulatory environment for crypto overall.
Exactly. It's a case study in strong operational execution meeting really favorable market tailwinds. Plus, you've got that forward-looking shift in their business model towards high-performance computing. Riot's journey really highlights how companies in this space are adapting, evolving beyond just mining. So maybe the final thought for you, the listener, is this. As Bitcoin continues to cement its place as maybe digital gold, and as AI demands more and more computing power, how will this growing overlap between AI, HPC, and crypto mining redefine what it even means to be a miner in the future? And what kind of completely new opportunities could that unlock down the road for finance? Something to think about.